Okay, we are going to go ahead and get started. We've been experimenting, in the last couple of webinars, we've been experimenting with some technology, live streaming to YouTube, Twitter, Facebook, Periscope, and we're taking us several attempts to try to perfect that, so hopefully we've got it down. So if you do happen to be on any of those sites, welcome, and hopefully you enjoy the presentation. So today we're going to talk about hedging your stock portfolio with the E-mini S&P. We were actually expecting a pretty big crowd. I have a feeling if the S&P was down 20 rather than up 20, we probably would have had double the attendance. But unfortunately, that's human nature. People tend to want to hedge when they feel like they need to, not necessarily when they should. Hedging does require some timing, and we'll talk about that. You don't want to hedge after the market's already gone against you. You want to hedge before. That's when your hedge is going to be the most beneficial for you. It'll be least costly and most effective. So anyway, if you're not familiar with who we are and what we do, we are DeCarley Trading. We're a futures and options brokerage service. We're located in Las Vegas, Nevada. We are a branch of the Zaner Group. Weather's better in Vegas. What can I say? We love it out here. Zaner resides in Chicago, and we visit, but that's about it. Vegas is the place to be. So if you have any questions or comments, or if there's anything that we could do for you, we'd love to have you. You can reach me by telephone or email. You can follow us on social media, Twitter, Facebook, Instagram. And if you're interested in learning more, we do have quite a bit of educational material on our website, DeCarleyTrading.com. There's over 30 videos. They're free to access. We have probably at least 10 to 20 articles on trading commodities. So if you really truly want to learn about commodities, please visit the site. So Cliff we already have a question. Cliff is asking, is this basically using E-mini contracts, futures or options, to basically lower the beta? I'm assuming that's what he's saying, for beta weighting. In a way, honestly, what we're going to talk about is something that an investor can customize to their own needs, depending on what their portfolio is, how their portfolio is structured. What we're going to talk about today is basically hedging an E-mini S&P, or I shouldn't say E-mini S&P, I should say an S&P 500 type portfolio that's broad market, well diversified, that sort of thing. If you're the type of investor that you're overweighted in technology or energies, obviously this isn't going to be a perfect hedge, but it will give you a decent hedge. But we're going to talk about also the idea that you probably don't want a perfect hedge. If you have a perfect hedge, then you're giving up all your upside potential, and so we'll talk about that. But you can use this to basically strip out the broad market and just focus your portfolio on something other than S&P 500 stocks. Maybe it's Russell stocks, that sort of thing. So there's lots of things you can do with the type of strategies we're going to talk about today. If you're not familiar with who we are and what we do, I mentioned we're a broker, but we are also strategists and authors. Well, I guess should say I, not we. I do write a column for Stocks and Commodities magazine. I write content for Jim Cramer's Mad Money. We cover everything from crude oil to gold to natural gas, treasuries, and stocks for Jim's show. About once a month, he uses our content on the show. And our brokerage clients do receive newsletters by email, and if they prefer, they can get text message, or we even have a mobile app with push notifications. These newsletters talk about day-to-day markets, and they also provide specific trading ideas and recommendations. So if you're interested in seeing more of what we have to offer, but you're over email and that sort of thing, and let's face it, email is getting to be kind of obsolete almost. Most spam filters catch a lot of the emails that people want to receive, and so on and so forth. So what we've decided to do is we created a mobile app to communicate with our clients. That way, in addition to emailing them, we could also communicate with them through push notifications and chat messages right there in our app, and so they always have easy access to us. I can't imagine that many brokers are that wide open and available, but we are. We try to be available almost around the clock, but we do sleep. And I've written 4 books on commodities. I've actually rewritten 2 of them multiple times. So if you count that, that's a lot of time invested. But if you are interested in learning, and you're wanting to start from the ground up, A Trader's First Book on Commodities is a great place to start. If you're beyond the basics and you want to get into strategy development, hedging, speculating, those sorts of things, market analysis, higher probability commodity trading might be something that you'd enjoy. It's available at all major book outlets, but it's cheapest on Amazon, of course. Okay, so let's finally get started. Before we get started, though, I do have to tell you that there is a substantial risk of loss in trading futures and options. Obviously, we are not investing, per se. We are speculating. This particular class is actually about taking risk out of a stock portfolio, but unfortunately, despite the fact that the futures markets were created for hedging, most people come to the futures markets for speculation, not hedging. So it is what it is, but this is where we are. So let's talk about what is hedging. Hedging is the practice of taking an offsetting position in a related asset or security to reduce the risk of an adverse price movement. People, when they talk about hedging, I've heard anywhere from, I've heard people think that buying natural gas because they're short crude oil is a hedge. I've heard all kinds of stuff. Generally speaking, a true hedge is an asset that is not only related, but almost identical or at least highly correlated, meaning they generally move in the same direction, and you would take an opposite position in one as you do the other. So as I mentioned, the futures markets were created for the purpose of hedging, but most people come to the futures markets for the exact opposite. They come for the action and the speculation. In fact, even people that their original intent is to hedge, like maybe they're farmers or ranchers, they end up speculating because it's human nature. We are attracted to what's exciting and where we think that there's profit potential, and so people tend to be more willing to speculate when they're participating in the futures markets than they might in their traditional stock account. But the idea is futures and options were here and created to help people shift price risk from a hedger to a speculator. You can also look at hedging as purchasing insurance, at least if you're buying puts, and we'll talk about that. We're going to talk about 3 different types of hedging. One will be just buying puts outright. The other will be selling futures to counteract negative movement on your stock portfolio. And the third will be what we call risk reversals or collars, where you sell call options and you use the money that you collect for those call options to buy puts, and it basically results in almost free insurance, and we'll talk about that. But the idea of a hedge is to shift the price risk away from you and towards somebody else that's willing to take that price risk, and those are obviously speculators. Everybody is always talking about the perfect hedge. In my opinion, it really does not exist in reality. If it did, it would eliminate all price risk. Markets aren't perfectly efficient. There's transaction costs, there's slippage, there's other interferences with the theory. Also, assets are rarely perfectly priced. Even if you're talking about something like corn, it's really truly impossible to have a perfect hedge, because a corn farmer, he's trading CBOT corn, but he might be located in a part of the country that has a slightly different price than another part of the country. So in other words, cash market corn has dozens of different prices depending on what part of the locale you're in. But the futures markets really only allow you to hedge one bulk price risk. And it's not a horrible thing. It's just, so you know, there is no such thing as a perfect hedge, and that's true of any asset, even something as seemingly obvious as corn. So if it was possible to put on a perfect hedge in the stock market, this is what it might look like. You would sell a futures contract with the exact same nominal value and composition of the asset being sold. So for example, if you owned $130,000 worth of S&P 500 stock, meaning maybe it's an S&P 500 ETF or index or whatever it is, or maybe you just put the portfolio together, but whatever case, it has to be identical to the S&P 500, and that in itself is not necessarily super simple. even if you're in an ETF, there's some rebalancing and all kinds of stuff going on. But if you did own 130,000 worth of S&P stock and you sold one futures contract at a price of 2,600, and again, that's assuming that you can get it at exactly 2,600, you would be hedging $130,000 worth of S&P 500 stock. So there you go. That's, in theory, a perfect hedge. As your stock portfolio goes up, your futures position would lose, and vice versa, but they would always be on balance. If it were possible to do this sort of thing, an investor would basically enjoy risk-free dividends in exchange for giving up capital gains. S&P 500 pays what, roughly around 2%, so it would be like guaranteeing yourself a 2% return without any risk, but again, no upside potential, and that's not what people go to the stock market for. Again, this is something that looks good on paper, but in reality, it really doesn't work this well. For starters, the S&P 500 fluctuates in value. You're not going to be able to get it at 2,600. More likely, maybe someone has $100,000 worth of stock to hedge, or maybe $500,000, whatever the case. It's probably not going to be exactly $130,000, which is what one S&P contract is worth at 2,600. If the S&P is at 2,700, suddenly the numbers change and you're hedging a bigger portfolio and that sort of thing. So in other words, you're probably not going to get your nominal value and your asset being hedged matched. So there's never going to be a perfect hedge. But again, that's really not what you want. I would say, stocks tend to go up over time. In the long run, the stock market always goes up. Sure, there's some rough years and there's some drawdowns and that sort of thing. But eliminating all upside potential is probably not what anybody wants to do. Instead, maybe a partial hedge, basically a not perfect hedge, is ideal because it offers downside protection without forfeiting upside profit potential. So there's a few ways you could do that. One would be to sell fewer contracts relative to portfolio size. So for example, if you owned $250,000 worth of S&P 500 stocks, you could sell one futures contract and roughly hedge half the account. Now, on a complete side note, I just thought of this as I was going through this, it's going to be really hard to match the contract size of the S&P 500 or the E-mini S&P versus your portfolio unless you happen to have increments of 130,000 in your portfolio, and I highly doubt that. But the CME is actually contemplating issuing like some sort of micro contract on the S&P 500, which would make this sort of thing a lot easier to perfect. So, for example, maybe it'll be roughly $10,000 per contract, and that way you can sell, if you have let's say you have a $50,000 portfolio, you could do 5 micro contracts and so on and so forth, and you could basically have a little more control over the size of the stock portfolio you're hedging. But you don't have to use futures. You can also hedge with options. I prefer the idea of options, and in fact, I prefer the idea of using both calls and puts, and we'll show you that in a minute. But there's really a couple. When you're using options, really what most people go to is they just buy puts. It's like buying insurance. But I'm going to show you that perhaps maybe a better way to do it is to buy puts and sell calls simultaneously. And that way you kind of get the best of all worlds. You get insurance without paying for it, except for through opportunity costs. And again, we'll go through that. So for those of you that think that buying puts to insure your portfolio is a good idea, I'm not saying it's a bad idea, but it's a very expensive idea. And you're really throwing good money after bad, in my opinion. Again, everybody has their own way of looking at things. But it's a lot like buying home insurance or car insurance. You pay the premiums every month or every 6 months, whatever it is. You're usually not going to need them. It is absolutely great when you do need them and it comes in handy, but most of the time you're just throwing that money away. It's just going up into pixie dust. So in my opinion, just simply buying puts and rolling them out and rolling them out and rolling them out is extremely inefficient. It's expensive. And another thing to keep in mind is if you do buy puts as your hedge, not only are you paying a lot of money, but it's only going to benefit you if you actually take the money off the table. The problem is sometimes people put their insurance on and it actually kind of pays off. The market sells off, their puts gain in value, and it emotionally, it's great because it takes a lot of the stress away from seeing your portfolio drop in value. And you see that these puts are doing exactly what you wanted them to do. However, very few people will actually take a profit on those puts. Most traders just watch the puts gain in value, but then hold on to them to expiration rather than taking a profit on the hedge. And generally speaking, they expire worthless anyway. So there really, truly was no reward to that hedge. There was only cost. If you don't take a profit when it's given to you on your insurance, it goes away. I'm going to show you a chart in a few slides to kind of put this into perspective, and you'd be amazed at how quickly these puts can gain in value and how quickly they can lose value. Buying put options outright is basically the equivalent of buying catastrophic insurance. It comes with perpetual cost that rarely pays off. So just to give you an idea, if the S&P futures is trading at 2,600 and you wanted to buy a put to protect yourself against a 200 plus point move, which would bring the S&P to 2,400, it would cost you 25 points or $1,200. So you're going to spend $1,250 just in case the market drops 200 or more points in the next few days. In the next few months. Keep in mind, it doesn't actually pay off unless the ES is below 2375 at expiration. So just for you to break even, if you hold all the way to expiration, the S&P has to be 225 points lower. Maybe it will be, but the odds are it probably won't be. So that insurance is for peace of mind, but it doesn't make a lot of monetary sense. The same trader could have bought a 2,300 put for 15 points or $750. So the price is obviously a little more reasonable, but you're only being protected from a 300 plus point move in the S&P, and that doesn't happen often. It happens once every 3-4 years maybe, sometimes more, sometimes less, but I'd say in the long run you're not going to see that very often. So if you add it up, if you continually roll out your puts and roll out your puts, in other words, you're buying puts every 60 days to replace the ones that are expiring, it's going to cost you roughly 1% each time, or 5 to 6% annually. So the stock market on average goes up, 7 to 10%? You're giving up half or more of that to buy insurance if that's going to be your strategy. So as you can see, that's a very expensive strategy that probably isn't going to pay out in the long run. And if it does happen to pay out, if we do have some sort of flash crash or some dramatic downswing, you better be quick enough to actually take a profit on that put. Otherwise, it's meaningless anyway. So is it possible to buy free insurance? We just showed you how expensive insurance can be for your portfolio, but can you get it for free? Actually, you can. It's actually, I don't want to say free. It's free in regards to cash and cash flow and money, but there are some opportunity costs, and we'll point those out. But in my opinion, a smarter way to insure an S&P 500 type portfolio is through the use of what they call risk reversals or collars. And the idea is you're buying puts equivalent to the amount of stock exposure wishing to be hedged. So for example, if you have a $250,000 portfolio, you might buy 2 E-mini S&P puts because that's going to cover roughly $260,000 worth of stock. Again, it's not going to be perfect. You just have to kind of round and do the best that you can, or based on how aggressive you want to be with your hedge or conservative you are, that sort of thing. If you only wanted to hedge half your portfolio, you would do one contract for a $250,000 account. So by a risk reversal, which is basically the idea of buying a put and then selling the same number of call options to pay for that put, you're getting free insurance. There's no out-of-pocket expense usually, and if there is, it's usually small, and it depends on how you structure your strike prices and that sort of thing. We'll look at an example shortly to give you a better idea. So you're not paying money, but you are giving up any stock gains above the strike price of the short calls. So if the market continues to rally above and beyond your short call strike price, you're still going to benefit from dividends, but you're not going to benefit from an increase in value of your portfolio, because now you're losing on the short call in your futures account while you're making on your stock account. But if you're hedging at the right times on upswings, not downswings, I think you'll find that more often than not, you can sell your call with a strike price in a place where the odds are you're probably not giving up anything. The market probably won't rally that far that fast to make a difference in your portfolio. So in other words, to summarize this entire concept, when we're doing risk reversals, selling a call and buying a put, we're mitigating the downside risk of our portfolio in exchange for capping profit potential. So I just want to make sure everyone understands. When I say free, I mean there's no out-of-pocket expense, but there are costs. We already talked about the opportunity cost of capping your profit potential. Okay, you understand that. But the margin cost is something you also need to keep in mind. So when we are hedging with the futures and options on futures, we are essentially doing so in another account. Even if you're trading with a broker-dealer who handles both stocks and futures, there's still two separate accounts, and it's because there are different marketplaces, there's different regulators, different rules, different compliance regulations overseeing everything, so they're two separate accounts. So if you have $150,000 worth of stock portfolio in your stock account, and you're using a futures account to hedge that portfolio, and the stock market rallies, there's a very good chance you could get a margin call in your futures account. Even though your stock portfolio is going up in value, you might be underwater enough on your futures account that you're going to have to pony up and add some margin. So there's definitely a margin cost. Again, as a net, you're not really losing money because you're making it on one side and losing it on the other. It's just that they're two separate accounts, and they're margined separately. So a lot of you are probably thinking, well, that's a good reason to trade with a broker-dealer because it's convenient. You can just move money back and forth really quickly. On one hand, yeah, you might be right in some ways, but on the other hand, you're going to run into a lot of problems trying to do this with a broker-dealer. When I say broker-dealer, I'm talking about a stockbroker that offers futures and options on the side. Generally speaking, they're stockbrokers. They're not commodity brokers. It's like going to a Chinese restaurant and ordering a hamburger. It's on the menu, but it's just not what they do. So it's probably not going to be what you're looking for. Like if you go to a true futures and options broker or a true commodity broker, such as ourselves, we're going to give you access to any strike price or option expiration month that is listed on the exchange. We're not going to restrict you. We're not going to tell you how far out you can go out with your hedge, which options you can trade, which ones you can't. We'll give you access to everything, and we're going to charge you exchange minimum margin. Most of the stockbrokers that offer options on futures, they won't allow you to sell options. If they do, they will charge you higher margins than the exchange require. And they will probably tell you can only sell options 1 or 2 months out. You won't be able to put your hedge on 3, 4, 5, 6 months in advance. So these are all some things to think about. So obviously I'm biased because this is what I do for a living, but I really truly believe if you're serious about trading futures and options, whether it's hedging or speculating, you should do it with a futures broker. Your experience is going to be much, much better. To give you an idea of what the margin might look like on a hedge like this, it really depends on how far out your strike prices are, how aggressive your hedge is, that sort of thing. But the margin can be anywhere from $2,000 to $5,000, maybe even a little higher if the S&P margin goes up. So these things fluctuate, but that'll give you an idea. So generally speaking, I would say, this is my recommendation, you could do it with less, but I would say if you wanted to hedge roughly $130,000 worth of stock in a futures account using the E-mini S&P futures and options like we're discussing, I'd say you probably want about 10 grand in your futures account, just so that it's not a headache and you don't have to worry about margin calls and that sort of thing. You could, in theory, you could do it with less, but that would probably be ideal. And Another opportunity cost you have to keep in mind is if you have 10 grand sitting in a futures account so you can execute this hedge, of course, that 10 grand is not necessarily earning money on its own. It's acting as hedge money, so you have to account for that in your cost of hedging. One mistake that I see traders make all of the time is they assume that timing doesn't matter when you're hedging because you're just trying to lock in a price. But nothing could be further from the truth. It is naive to believe that timing is irrelevant when you're hedging. In fact, it's probably more relevant when you're hedging than in almost anything else. In my opinion, if at all possible, hedges should be put on when you most likely think they aren't needed. For example, when the S&P is moving up and everything feels comfortable and you feel like you probably don't need a hedge, that's probably when you need a hedge. Remember in January when the S&P just kept roaring higher, no one could figure out when it was going to end, and everybody was bullish, and everybody was at the party, cheering, and anyways, it was out of control. But people that put on their hedges then did far better than people that tried to put the hedges on in early February after they realized, wait a minute, this market won't go up forever. We do need some protection. And also, hedges should be offset or reduced as the market moves lower. So if you put on a hedge and the S&P sells off and you're thanking goodness that you had that hedge on because now your futures hedge is making up for losses in your stock portfolio, you need to make sure you lock some of that in your futures portfolio. The problem is you don't ever know when the bottom of the stock market is going to be. So in this most recent correction, maybe you locked in your profit after a 6 or 7% correction, and then you had to suffer the last 2 or 3, 4%, whatever it was. But the reality is, if you picked up an extra 7% and you still suffered 3, 4%, that's a heck of a lot better than writing it all the way down without any protection. So don't be scared to lock something in. That's what it's there for. Okay, so Cliff is commenting that I'm telling you all of the negatives. Well, that's because that's my job. As a broker, I need to make sure that everybody understands there's give and take with everything in trading. There's never going to be a perfect solution. There's no free insurance. There's no easy money. So you have to just weigh your pros and cons and do what feels right for you. Everybody has different personalities and risk tolerances and ways to think of things. The idea is you want to put yourself in a place where you're most comfortable, because if you're comfortable with the risk and you can sleep well at night, you're probably going to make better decisions than if you're stressed out and worrying about every tick in the market. So we're going to talk about how far out in time. Cliff is also asking how far out in time would you establish these options, and that's a personal choice. I would say with this type of a hedge, you probably want to do 2 or 3 months. If you start going further than that, I think you're going to run into a situation where the options might not move quick enough for you, or the margins might be a little higher, that sort of thing. So I'd say optimally about 2 or 3 months. And then, of course, you'd have to continue to, after the 3 months is up, if those expired worthless, you'd put it back on. So you'd be looking at rolling over about 4 times a year. Okay, so I really wanted to show you what I'm talking about when I say a hedge doesn't do you any good if you don't take a profit. So this is the January peak we were just talking about a minute ago, where it just seemed the market could do no wrong. The price of the S&P is over here. This is the price of this option. This is the June 2400 put, and you can see it's here. As we know, options generally lose value over time. This is what normally happens in an option market. But in January, volatility exploded. The S&P dropped like a rock. This option went from $10 in premium, which is a $500 expense, to 140 points. So this option that was $500 at the end of January was suddenly worth $6,500 a few days later, maybe a week later. Obviously, that is a massive, massive gain for somebody that was smart enough to buy insurance near the top. their $500 turned into $6,500, meaning they were making $6,000 on a $500 insurance policy. Unfortunately, if they didn't take that opportunity to lock in their profit, they could have very easily seen that option dwindle all the way back down to what they paid for it. So again, the hedge does you absolutely no good if you don't lock in a profit. Even if somebody locked in a profit here and they only made $2,000 or $3,000, that's still a lot better than giving it all back. So it takes a little gumption and it takes a little risk, because obviously you put the put on as a risk aversion tool, but at some point you're going to have to take a profit on it and face the risk head on. Otherwise, you're really not doing yourself any good. You're just costing money for no reason. You're just spending money for no reason. Okay, so again, timing is everything. When the ES is moving higher, calls are generally overpriced and puts are underpriced. So this type of a hedge, a collar or risk reversal, whatever you want to call it, when you're selling calls and buying puts, it's best put on when the market's going up, because you're getting more money for the call you're selling and you're paying less for the put that you're purchasing. So as a result, you're getting a higher cap on your profit potential. You're getting a higher level in which the downside protection kicks in, and you're less likely to incur margin issues in your futures account. So in other words, hedge when you can, not when you need to. Don't wait until the house is on fire to buy insurance. Do it when nobody thinks you need it. So let's look at an example of a long put hedge. It's actually basically the same option that we looked at, the June 2400 put. As we know, during this decline, it jumped up to a ridiculous price. But let's assume right here the trader can buy it for 10 points or $500. Basically what that trader is doing is buying insurance against the 270-point look. The S&P right here is at 226.70. So this trader only makes money on the put, on the hedge, if the market drops 270 points. Actually, if you want to be specific, 280 points. Before that, the hedge does no good. So you're just throwing $500 away every 2 or 3 months like clockwork. And that's generally what's going to happen with that type of strategy. And to be honest, I mean, obviously you'd rather it expire worthless. You don't want that to have to come into play, because you're probably going to be losing, obviously, money on your portfolio. But the point I'm trying to make is that insurance that you spent $500 on is doing you absolutely no good unless the market just completely falls out of bed. And in that case, you probably have bigger fish to fry anyway. Okay, so let's look at how a short futures hedge might work. So the same trader, instead of buying an out-of-the-money put, could have opted to just sell a futures contract. Now, if your goal is pure price protection, that's it. You want to lock in your price. You've had a good year. You want to just earn dividends the rest of the year. You're okay with giving up all upside potential from this particular point. Go ahead and sell a futures contract. You're going to be hedged 100% as long as your portfolio is exactly $130,000. If you're trading a $500,000 portfolio and you want a small hedge just in case something happens, you could sell one contract and go for there. That way you're basically locking in the value of $130,000 and leaving the rest of it to fluctuate. So you can play with this. There's not a lot of black and white. It's not science, it's art. But again, if you did implement a perfectly hedged portfolio, which is almost impossible to do, but you'd basically still get the dividends. Your portfolio is still collecting dividends. You just aren't, you're just not being exposed to the downside potential. Okay, sorry about that. My puppy gets a little anxious sometimes. Okay, so let's look at how a risk reversal might work. So in a risk reversal, this is the one that I think is probably makes the most sense, but I'll let you guys be the judge. Investors create free insurance by selling a call option to pay for their put option. In this example, somebody might sell a June 2780 call for $10, which is $500 if you're talking real money, and then buy a June 2400 put for $10 or $500. Aside from transaction costs and maybe slippage, you're probably not going to sell for exactly 10 and buy for exactly 10. But you get the idea. You're probably not going to pay much at all other than transaction costs. You're getting that insurance for free. So if the bottom falls out from under the market, you still are only benefiting if it drops below 2400, but at least you didn't pay for it. You could adjust this by selling a call that's closer to the money and then buying a put that's closer to the money. And this type of thing makes a heck of a lot more sense when the market's on an upswing. So obviously, it's easy to say in hindsight, but in January, this would have worked beautifully if somebody put the hedge on near the peak in January. If they would have tried it in the February trough, wouldn't have worked so well because you would have been paying a fortune for your put, and then you probably wouldn't have got enough for your call to make it worthwhile, and you would have capped your profit potential at a very low price. So somebody's asking, do you use the same expiration for the call on the put? And the answer is yes, you do, absolutely. I would. You don't have to. Again, this is trading. There's no right or wrong way to trade. If you think there's some sort of edge in doing a calendar spread, then by all means do it. But for speculation purposes, we generally do just that, calendar spreads. For hedging purposes, I think you're probably better off using the same expiration month. The idea is just to keep it simple and to keep your protection in place at all times. Okay, so Cliff is asking, how would one know that the ES wouldn't continue to drop beyond the long strike? Well, that's just exactly it. So if you buy insurance, if you buy the 2400 put, and the market drops to 2500 like it did in February, we're talking about this right here. It never got to 2400. Remember the slide we looked at a few minutes ago suggested that that option was up $6,000 at that point. So somebody that bought it here was making $6,000 after this drop, even though the price never got to their strike price. So again, you have to, one thing I guess I never pointed out, but I should have, if you're not familiar with options, the option never has to actually reach your strike price for that option to gain in value. It just has to see an increase in volatility or an increase in price movement towards the strike price, and usually that's enough to do it. So it's true, if this hedger would have taken their profits here, who knows, maybe the S&P would have continued to drop. But that's a risk you have to take, because if you don't take a profit at some point on your hedge, you might as well have not have had the hedge in the first place. So you're right, it's going to expose you to additional risk and stress once you take that hedge off. But knowing that you hedged yourself on 7 or 8% of the move is better than not having a hedge at all. So I want to thank everybody for coming out today. I hope that you learned something. I apologize for my dog. Who knows what she has going through her mind. She's thinking about birds in the yard, I guess. Apologize for that. If you have any questions, or if there's anything that you can do for us, please, if there's anything we could do for you, please let us know. If you want to learn more about trading commodities, please check out our books. They're available on Kindle as well if you're into e-reading. Here's my contact information. Please let me know if you have any questions, if I missed something during the class, or if you thought of something afterwards. And don't forget to follow us on social media. We do post a lot of charts and commentary, and we try to keep things interesting. So check us out there. Thanks again, everybody.